Hey, what is up guys? In this video, I will share with you my findings on why inflation will persist for a longer period than the 2 years that the Federal Reserve previously suggested. If you have been investing in the US market or at least read the news, you should already know that the COVID pandemic had forced the Feds to print money continuously in order to prevent the US economy from falling apart. They did so by going all in with their unlimited bond buying plan in 2020, and as a result, the US M2 money supply surged to an all-time high and the S&P 500 index surged to a nearly 27% gain in the year of 2021 alone, all while every businesses and individuals were suffering from the impact of COVID lockdowns and supply chain problems. But of course, this is not sustainable. All of that resulted in a sky-high inflation of almost 7% per annum at the end of 2021, and the Fed's balance sheet has skyrocketed to a historic high of almost $9 trillion. And because of that, the Feds had to start tapering, which means they are stopping the bond buyback program, which means no more free money for the economy, and we all know what happened to all the risk-on assets in 2022. Now in September, the Feds are ramping up their quantitative tightening program to a rate of $95 billion a month, which also means removing $95 billion of money from the US economy every single month. But have you ever wondered why and where did the Feds got this 95 billion number from? Why not 50? Why not 150? Why 95? Well, let's rewind back 2 months ago. Jerome Powell mentioned that getting down to new balance sheet equilibrium could take 2 to 2.5 years. So that suggests that this quantitative tightening program, or QT in short, could take at least 2 years from now. So if you times 2 years or 24 months with $95 billion a month, that is 2.28 trillion US dollars. And if this number doesn't ring any bell to you yet, well, it is actually almost the same amount of money, $2.2 trillion, that is now in the reverse repurchase agreement market, or short for the reverse repo market. The reverse repo market is basically a place where the banks in the US can buy short-term securities from the Federal Reserve to gain extra interest rates. And let me give you an example. We all know that banks make money from the interest income that they receive from giving out loans to us, right? But at the same time, since consumers like us deposit our money in the banks have no choice but to pay us some interest on our savings balance. We all know that. So since the amount of money that the consumers have right now is significantly higher due to the free money running in the economy, the banks couldn't keep up with the loan, and as a result, they will have a huge surplus of cash deposits in their bank account just sitting around and doing nothing. So what did they do? They go to the reverse repo market to buy some short-term securities from the Federal Reserve, and the Feds have to pay the bank some interest in return. So this reverse repo market has ballooned to a sum of over 2 trillion US dollars, and the Feds cannot just say they don't want to deal with the banks. So the only way for them to get out of this mess that they created in the first place is by reducing the amount of securities available in the reverse repo market. But they have to do it slowly in order to not shock the economy, which is why now we are seeing the $95 billion a month of QT program. Hopefully that explains why. But let's not forget, quantitative tightening, QT, is not just the only way the Fed is fighting against this inflation. They are also increasing the interest rates at the same time at a very aggressive rate, and economists are expecting the rate to hit at least 4% by the end of 2022. And for what it's worth, we are closing in to the Fed funds rate that the US had right before the 07-08 subprime mortgage crisis. Yeah, it's pretty worrying, not gonna lie. And before we get too carried away and believing the Feds will be able to carry out their 2-year QT program at $95 billion a month without any issues, well, allow me to remind you that the US government have very limited budget remaining because their debt to GDP ratio stands at 137% as of the recording of this video. And very recently, the US Treasury Department announced that the federal budget deficit continues to widen to $220 billion in the month of August. Budget deficit means the government is spending more than what they can collect in return, aka revenue, which are mainly in the form of income tax. If you look at this picture, the US government is spending about 7% of their 2022 budget on interest on debt. So for every 1% of rate hike that the Fed does, 1% on the $30 trillion federal debt, this means the US government have to fork out an additional $300 billion worth of interest payment. and that will make the interest payments portion go closer to the same amount that the US government is spending for their defense sector. Let that sink in. Now, over on the revenue side of this equation, we all know that the markets have been on a downward trajectory this year. The S&P 500 index is down almost 20% year to date, and the crypto market is literally bloodbath, where Bitcoin and Ethereum is down almost 60% year to date. What this means is there will be lesser capital gains being realized this year, which means there will be lesser capital gains tax revenue for the US government. And based on my calculation from this data by OECD, the capital gains tax from individuals and corporates sum up to about 5% of the total tax revenue. So just imagine the weights on Jerome Powell's shoulders right now. On one hand, he has to fight inflation by hiking the rates aggressively. On the other hand, he cannot raise the rates too much, which will affect the financial well-being of the US economy. And this all leads to the conclusion that it is almost impossible for the quantitative tightening program to run smoothly for the course of the promised 2 to 2.5 years. The Feds will come to a point where they have insufficient budget to fund the country's budget requirement, and that is when they would have no choice but to pivot from their QT program and continue printing more money to keep the country running. And ladies and gentlemen, what that also means, we might be on the path towards a long-drawn inflation that could stretch past the 2.5 years time frame, maybe 3, maybe 4, maybe 5 years or more. No one knows for sure, but one thing we know, the possibility of a soft landing happening is going to get thinner and thinner and thinner as time goes by. Now, I'm not saying that the Feds will immediately start pivoting from their current hawkish stance to a dovish one. That's just not possible in the coming months. I would say probably in the later half of next year or the year after, when the interest rates are closing in the 5 to 6% range. And then you will start noticing that the Feds will stop raising interest rates for some time, holding on a wait and see approach, and then they will start cutting rates again to print more money. So hopefully this gives you a good idea of what to expect for the coming year, rather than believing the Feds blatantly that everything will go as planned, because from my research, it won't. Alright, I hope you liked this video. Give it a thumbs up if you found some value from it. Remember to subscribe, and I'll promise to keep you updated with the latest news. Thanks for watching. I will see you in the next one.